Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, a practitioner within the financial services industry in Kenya. We are learning about equity portfolio management. The focus of today's lesson is equity index weighting schemes. In today's lesson, we are going to learn about the types of indices that exist within the equities market. Thereafter, we're going to analyze the biases of those index weighting schemes. So to jumpstart this topic or this lesson, we are going to analyze the types of indices. Now, types of indices. The first type of index that exists is price-weighted index. Price-weighted index. There. Now, under the price-weighted index, we can say the following. We can say refers to the arithmetic average. Arithmetic average of prices in the index. Price-weighted index refers to the arithmetic average of prices in the index. Build on this explanation and say that it adds market prices. Adds market prices of each stock. Adds market prices of each stock in the index, then divides in the index, then divides the total by the number of stocks, in the index. So we're saying that it adds market prices of each stock in the index, then divides the total by the number of stocks in the index. Now, we do not need to do an example of the price-weighted index. This has already been covered in the new unit that is called Introduction to Finance and Investments. And so if you want to see how we can be able to compute the price-weighted index, please refer to the Manifested e-learning platform unit called Introduction to Finance and Investments. Here, we just need to build on equity portfolio management types of indices, and then we try and assess and analyze the types of biases that are there on each index. Number two is market capitalization weighted index. Market capitalization weighted index. This is also called a value-weighted index. Under this price-weighted index, we are only going to consider the prices or the market prices of equity securities. Under this market capitalization weighted index, we will be able to get the price times the number of shares outstanding. So price times number of shares outstanding, like that, gives us market cap or the value of equity security. Now, let's explain what the market cap weighted index is all about. You can say it sums the total market values, of all the stocks in the index, of all the stocks in the index. It adjusts for stock splits. It adjusts for stock splits. We are saying market capitalization weighted index, it sums the total, sums the total market values of all the stocks in the index. It adjusts for stock splits. So the difference between the price weighted index and the market capitalization weighted index, just to mention in passing, is that the price weighted index only considers, these are the stocks that have actually been listed over here, the market prices, it only considers this column over here. That market prices over there. So we're saying that it is just an average of all the stocks in the index. If the index reaches outside over there, it just sums up all the stocks in this index right over here, and then divides by it divides by the total number of stocks in the index. So this, you add up all of this and then you divide by all of these values in the index, not on the entire NSE or the entire index or the entire exchange listed securities. No, we're only saying that if these other securities are included in the index, you just add the prices of the securities and divide by the number of prices in the index right over there. Now, market capitalization weighted index, it includes the number of shares outstanding, like that. So this is market prices, number of shares outstanding right there, like that. I'm assuming these are the number of shares outstanding. Then you're able to get the market cap, that. So you get this times this, you get y, and so on and so forth, like that. That. So this market cap, if the index reaches up to that point over here, like that now, price weighted index, the index is up to over here, we're only considering this column over here. Now, market capitalization weighted index, also called value weighted index, factors in these values over here. So it sums up all of these like that in terms of market values, and gets the market values and divides by the total market value of, or divides by the total number of securities which have been included in the index over there. So we are saying that in terms of market cap, the challenge is that you could be able to have that security trying to have a large market cap. Rather, I'm saying this security might have the largest market cap over here. Say, for example, in this case in Kenya, Safaricom. Safaricom has got largest market cap. If it has the largest market cap, if the stock price of Safaricom goes down, it means it will impact on the overall value of what? Of the index. There. So it influences the index significantly. So that's one of the biases that we shall be looking at shortly. So that's the difference between market cap and price-weighted index. So we can move on to another types of index weighting scheme. Number 3, free float adjusted market capitalization index. Free float adjusted market cap weighted index. There. Free float adjusted market capitalization weighted index. We can say the portion of the firm's outstanding shares of the firm's outstanding shares are available for purchase. Outstanding shares are available for purchase. It is adjusted. It is adjusted. It is adjusted for the amount of stock. The amount of stock. For the amount of stock that is actually available. We can further build on this and say that it assumes that the investor has bought all the available shares. Has bought all the available shares. All the available shares. What are we saying about free float adjusted market cap weighted index? The portion of the firm's outstanding shares are available for purchase. It is adjusted for the amount of stock that is actually available. I'll be able to shortly explain. It assumes that the investor has bought all the available shares. If there are 100,000 shares that are available to the investor, that are available to investors, what we can do is that a portion of this is actually reserved for the founders of that company. So let's say maybe 50,000, not 50,000, maybe say 20,000 shares. So out of this, 20,000 shares are available for the founders. And that means what? It means that only 80,000 shares will be released to the public. What we are saying is that the portion of the firm's outstanding shares are available for purchase. So this is available for purchase by outside investors. These ones are actually reserved to the founders of the company. So we are saying that this index of free float market capitalization weighted index adjusts for the amount of stock that is actually available. So we are saying that the free float is just the free amount of free shares that is available for investors. So there is always a bias in this free float adjusted market capitalization weighted index, in the sense that what happens is that the index might be adjusted or might be biased upwards because of this issue of the difference between the number of shares issued to the founders, the number of shares issued to the public, and that brings about some upward bias towards the index. Let's move on this other side. We analyze the fourth type of index for equally weighted index. We say that all stock returns are given the same weight. All stock returns are given the same weight. This implies that the index is computed as if the investor has an equal. equal investment in each stock. Equal investment in each stock. Equal investment in each stock in the index. In the index, and you can put a full stop over there. We build on this and say that the index must be periodically rebalanced. Index must therefore be periodically rebalanced. Must be periodically rebalanced. Now, what are we saying about equally weighted index? We are saying that all stock returns are given the same weight. And this implies that the index is computed as if the investor has an equal investment in each stock in the index. The index must therefore be periodically rebalanced. Now, once we have learned about the types of indices, we can move on to another subsection that talks about the biases of these 4 types of indices. So biases. Index biases. So we say that number 1, what is the bias of a price-weighted index? So price index, price-weighted index. So we say the major bias is that the price, the securities that have higher prices influence the direction of the movement. The movement of index. The index. The major bias is that securities that have higher prices influence the movement of the index. Of course, in a particular direction, obviously. We talk about movement, we're meaning, or we are referring to movement in terms of direction. So if you have securities such as X, Y, Z, V, this one has got 20, this one has got 50, this one has got 150, and this one has got maybe say something like, for example, it has got maybe say 20 or 19, maybe 10, like that. So these are the index constituent companies, X, Y, Z, V. We're saying that the major bias is that securities that have higher prices, this one, is the one that is going to dictate the movement of the index. So if this one increases from 150, and they are saying maybe at the end of the month end, we're saying now instead of 20, it goes to 17, here it goes to 55, and this one goes to maybe say 120, like that, and this one remains around 11, like that. This is the one that's going to dictate the movement like that. So the index is going to move down generally, even if this stock moved up. Yes, you can see this one moved up from 50 to 55 at the end of the month. This one, because it has moved down to 120, this is the one that is going to dictate the movement of the index. That is the major bias of price-weighted index. Let's move on to the next one. Market capitalization weighted index. Because the market capitalization weighted index talks about the market caps. So number 2. Market capitalization weighted index. Consistency, yeah. So market capitalization, we still have that example over here, X, Y, Z, V. Here the prices are 20, 50, 150, 10. So we have to get the market cap by multiplying with the number of shares outstanding. Number of shares. This is the market price. Market prices. So number of shares, maybe it is 100,000. This is maybe say 200,000. This is maybe say 100,000, and so on and so forth. This one is maybe 50,000, like that. So the market cap has to be determined. And how do we get the market cap? Market cap, this times that. So 20 times that is 2 million. This one is 5 times 2 is 10. Is 10, and then 1, 2, 3, 4, 5. That's 1 million. This times that, we're saying is 150. 1, 2, 3, 4, 5. As you can see, the impact. Then this one is going to be 10. 5, sorry, pardon me. 5, 1, 2, 3, 4. 500,000. So we're saying that this market capitalization weighted index is impacted more based on the one that has got higher market cap. You can clearly see Z down over here is the one that has got the highest market cap. Now let's see the impact. Now, just the same way as we had done under the price weighted index, let's see the impact if the prices change to the values over there. So you're seeing that this you're getting is 20, like that. This is 5 times 2 is 10. Is 10, and then we add 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6. So this one should be 10, like that. 5 times 2 is 10. It should be 10 million. Should be 10 million, pardon me, for that error. Pardon me for that error. Should be 10 million, like that. So we are saying what? We are saying that the one that has got the highest value over here is the one that has the greatest impact, right there. So what is the bias over here? The bias right over here, clearly you can see, is that if this one moves now to the prices are, so end month, in terms of value. So we have 17, 55, 120, and 11. Like that. So this one, so we just multiply, of course, times the number of shares outstanding. So this is the one that is changing, the market prices. So the ending value is going to be that price right over there. So we're saying we need to have the following. We'll get 17 times 100,000 to 1.7 million. So value 1,700,000, like that. Then the next one we are saying is going to fall to 55. We are saying it's going to be 11 million over here. Like that. And then this one we are saying is going to be 100,000, and it's going to be times 120. It's going to be 12, 1, 2, 3, 4, 5, 6. And then this one is going to be 50,000 times 11. Is it 11? Yes, it's 11. It's going to be 550,000. That. So what are we saying? we are saying that this is the one that has got the greatest value and is the one that is actually going to dictate and the movement of the index there. So the bias, we can say, the bias is that the value that the security that has got the highest value or highest market cap is the one that actually dictates the movement of the index right there. So we can just indicate that in writing. So I can write that over here. We can say that the major bias in this index weighting scheme is that the security with the highest market cap dictates the movement of the index. The major bias in this index weighting scheme is that the security with the highest market cap dictates the movement of the index, as I have just demonstrated. Let's move on so that you can be able to see the free float adjusted market capitalization with index, the biases. Free float adjusted market capitalization weighted index. Under free float, we are saying that based on the explanation I'd given, that you could be able to float 100,000 shares. But in the arrangement, you find that 20,000 are given to the founders, and maybe the balance 80,000 is floated to the investors or the available investors over here. So what is the bias here? The bias is that this the index could be adjusted or could be inclusive of the free float, and sometimes this 80,000 could even surpass the 20,000, and maybe say that we're saying that the number of shares that could be determined could even be slightly more, like more than the 80,000 that is actually there. So we're saying it could be 80,000, or sometimes it could even be 90,000, which factors in the free float, especially more so when the founders of this weighting of the index decide to actually release some of the shares to other investors. We're saying that that is going to be a significant bias thereon. What am I saying? The bias under free float adjusted market capitalization index is that the index, which is formulated based on the available shares to the investors, could be adjusted upwards, especially more so when the founders actually decide to release some of the shares to the market there. So that is the major bias. We're saying that the major bias of this index weighting scheme is that the free float shares could increase following the release of shares that had been shelved. Release of shares that had been shelved by the founders. That's the major bias. The major bias is of this index weighting scheme is that the free float shares could increase following the release of the shares that had been shelved by founders. The fourth type is the equally weighted index. Equally weighted index. Under equally weighted index, we had said that all stock returns are given the same weighting. And so we're saying that small cap stocks are the ones that could be able to have a major impact on the equally weighted index. We're saying the small cap stocks are which ones? So these are securities which are listed on the exchange, those ones. The number of stocks, the number of prices, so prices are indicated right there beside each of those stocks. The number of shares are also indicated. So the market cap is provided. So you get these values over here, X, 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 and so on and so forth, like that. Once we have this, we are saying we can arrange this market cap in descending order. In descending order. There's a button in Excel that is indicated like that, like that. Sort. Sort. So we arrange it based on descending order. Descending order means that you start from the largest over here, you move down to the smallest. So what happens? So we're saying here you'll have the high cap or large cap. Let me say large cap. Cap stocks. And here you'll have small cap stocks. So in an equally weighted index, the weights are assigned, the weights of the returns of the securities are assigned equally. And so we are saying that the major bias of equally weighted index is the fact that small cap stocks tend to have more magnitude onto the equally weighted index as compared to large cap stocks. So we are saying that the index under the equally weighted index is computed as if the investor has an equal investment in each stock. This index must therefore be adjusted periodically must be rebalanced periodically. So these ones are the ones, or the stocks which are maybe from right over there are the ones which will have a major impact on index. And we can say something on that note. So we say that the major bias of this index weighting scheme is that small cap stocks will impact on the index due to the fact that small stocks with small values, that stocks with low prices or low small shares outstanding will impact or not impact, will tend to magnify the index returns. Magnify the index returns. So we're saying that the major bias of this index, this should be small, major bias of this index, the major bias of this index weighting scheme is that small cap stocks will impact on the index due to the fact that stocks with low prices or small shares outstanding will magnify the index returns significantly there. And that said, this brings us to the end of today's lesson. I have an assignment for you. The assignment says, moving over on this other side, saying that assignment explain equity index weighting schemes. Number one, explain the equity index weighting schemes. Equity index weighting schemes. And number two, we say analyze the biases. Analyze the biases of the above equity index weighting schemes. Explain the equity index weighting schemes that you know, and analyze, number two, the biases of the above equity index weighting schemes. This brings us to the end of today's lecture. Like I've already said, thank you and God bless you.